Thank you for joining me. I'm Alex, and I'm here with a continued sale on the stock market. So we're down 4% today, and cumulative, I think, over 10% down on the week, which is certainly terrible. And I don't remember a week this terrible. So obviously, I haven't been paying attention to all the weeks, but it's definitely up there. So we're looking at Zynga, something today. So a manufacturer of mobile games, and they've been around since the days of Farmville, which is their main thing, or used to be anyway. They have obviously made many other games since then, and Farmville really isn't a thing anymore. So currently, their price is $6.75 per share, which gives them a market cap of $6.4 billion. Dividend is zero. I don't expect that to change within a decade, so obviously not counting on that. Revenue, $1.3 billion, up almost 50%. Earnings, $42 million, up almost 200%. And that gives them PE of 169 with a forward PE of 25. Forward PE of 25 isn't terrible, especially for a company that's growing 50% year over year. So definitely not terrible there, definitely going in the right direction, and forward PE of 25 probably justified for a company that's growing this much. Total assets, $3.6 billion, total liabilities, $1.7 billion, which gives them a total stockholders' equity of $2 billion. Obviously, liabilities tripling, not a great thing, but overall, the equity went up 25%, which is obviously going in the right direction. Now, to summarize that a little bit, dividend investors are just out at this point, obviously. Value investors, I think, would probably want to avoid this stock as well. Obviously, PE of 169 is not great, definitely not great. A forward PE of 25 is still not great for a value investor. A lack of a dividend is obviously also bad. And there are some things on the balance sheet that I wouldn't really like, which is almost $1.5 billion in goodwill. And goodwill, I think, is always a terrible thing. Other people might disagree, but I don't even know why they call it that. I hate it. So if you take the goodwill away, which you probably should, then the total assets are just $400 million higher than the liabilities, which would be pretty terrible. For a growth investor, on the other hand, a company that's growing revenues 50%, that's growing earnings almost 200%, is obviously a pretty good deal, and a forward P of 25 for a company that's growing this much is obviously also a pretty good deal. And so I think that if we kind of disregard the balance sheet, then for a growth-focused investor, this might be a pretty good stock to look into. Obviously, you should read the full 10K, which came out a couple days ago, I think, and read through the guidance and the risk factors. But overall, at this point in time where the coronavirus is doing its thing and travel stocks are not performing all that great, you have a company here that's very much not affected by travel problems and fears of a global pandemic. So for that reason, I think it makes sense to kind of diversify into the stock a little bit if you're a growth investor, and you should obviously always be very well diversified as a growth investor because the risk is so high. But for that reason, I think this is a pretty good stock at this point, and I think that you should probably do your own research, but look into the stock and see what you think. I am not picking up the stock because I don't really like to invest in growth companies with no dividend and a reasonable risk of failure. But for a growth investor, I think it makes sense to look into it. Anyway, that's it for me for today. If you like this video, make sure to subscribe. I'm coming out with more videos every day before market open. I hope you have a successful day.